Hello and welcome to our Understanding Markets video update. We're recording this on the morning of Tuesday, the 15th of November. I'm Hellen Dalton. I'm a Senior Investment Manager here with Cantor Fitzgerald, and I'm joined once again by our illustrious Chief Investment Officer, David Beaton. David, fantastic to see you actually in person for a change.
Yes.
Here at number 23, Stephen's Green, our HQ. So obviously there has been a lot of news, and I feel like in our updates, we've talked non-stop this year about inflation, but it was back in the news again last week.
It was indeed, Helen. It was a pretty pivotal week for markets last week. As you say, we've been speaking about inflation persistently over the course of the last year or so. And the Federal Reserve, amongst other global central banks back in 2021, were saying that inflation was going to be transitory, and it turned out to be anything but. And it certainly moved far ahead of where they had anticipated. And as a result, we've seen the Federal Reserve be very aggressive in its pace of interest rate hiking over the course of 2022. It's increased rates by almost 4%, which by any stretch is a very aggressive pace of tightening. And they've been focusing on trying to get US inflation, which had been running at about 8%, back down to its target level of 2%. But last week we saw the first glimmers of an improvement in the inflation situation, albeit very modest, it has to be said. But year-over-year inflation came in at 7.7%. That was below forecasts for 8% and below the prior month's reading of 8.2%. So still very elevated, but what was encouraging about the inflation data last week was the fact that a lot of the component parts within the inflation reading, like healthcare, used cars, food, and a lot of those areas that have been showing very high rates of inflation in the first half of the year are starting to roll over and turn negative. And that is giving the market cause for optimism that the Federal Reserve, having said that they're going to continue to raise interest rates into 2023, may actually slow down the pace of rate increases. I think the market expectations for them to stop is probably overdone, but the fact that they, having increased rates by 75 basis points or 0.75% at each of their last four meetings, it means that they probably will go maybe in smaller increments of maybe 50 basis points at the December meeting.
And of course, markets very much view this as good news.
Yeah, the markets have been looking for some signs of a slowdown in the pace of rate increases. We've already seen it from a number of other central banks globally. The Bank of Canada, the Reserve Bank of Australia, the Norwegian Central Bank have all in recent meetings increased rates by less than what the market had been anticipating. And the market really has been waiting for the Fed to give a signal that it is going to do the same thing. Now, it's not guaranteed that they will, and quite a number of the Fed speakers, particularly Jerome Powell after the press conference after the last rate increase, tried to quash any notion that the central bank was going to take its foot off the pedal in the pace of interest rate increases. But post the inflation data, there's been 4 or 5 members of the Federal Reserve Open Markets Committee who have said that maybe now is the time to stand back and reflect on how their 4% rate increases that they've done this year are feeding through into the economic cycle. Interest rate increases work with a lag effect, and I think that the Fed need to probably stand back at this point in time and see, are the rate increases working, and they need to be mindful not to cause a situation where there's a very severe recession in the US.
And I think that one of the indicators they're looking for is things like non-farm payroll. So how is that looking at the moment?
Well, again, I mean, it's a bit of a perverse analogy, but the last set of non-farm payroll data actually showed an increase in the unemployment rate, which you would think is not good news. But from a market perspective, it was well received. The unemployment rate increased from 3.5% in September to 3.7% in October. And this is all part of the Fed's agenda in their rate hiking cycle to try and slow down the pace of growth in the US economy to try and keep inflation lower. And what we've seen over the course of the last week in particular has been a significant increase in the amount of big tech companies in particular laying off, announcing layoffs in the tens of thousands in some cases. Amazon reportedly going to be announcing cuts of 10,000 this week. We've seen Meta, we've seen Twitter, we've seen Stripe, even in the local economy here, the payments firm. So that's going to add to the upward movement in the unemployment rate. And that's what the Fed is looking for. They're looking to try and tighten monetary conditions so that inflation doesn't continue to grow. And to that end, bad news is good news for the market, unfortunately, but again, it's not going to be disastrous news.
Yeah, and in a way, it's also having a knock-on effect on the US dollar.
Yeah, the US dollar has seen a significant reversal, particularly in the course of the last week since that inflation number came in. And just to give the viewers a kind of a guide to why the dollar has weakened. I mentioned earlier that the Federal Reserve had indicated that they're going to continue to increase interest rates, but the pace of those increases is expected to be slower. So before the inflation number, the market was expecting the terminal rate, or the highest rate that the Federal Reserve would go to in the rate hiking cycle was about 5.2%. We're currently at about 4%. Post the CPI data last week, that level of expectation has fallen back to about 4.75%. So the market is now starting to price in a lower rate of the terminal rate for US interest rates, and at some point in time in late 2023 or early 2024, the potential for rate cuts. And that has been reflected in dollar weakness. So the dollar, since its peak against the euro at about 96.5 in the middle of August, is now about 104.30 as before we came into the room here. So that's a decline of about 8%. Now that's very important when you're looking at equity markets in particular, because the strength of the dollar has been one of the drags on some companies in the recent reporting season. So any weakness in the dollar means that the value of their overseas earnings for US companies increases, and that should be more positive for earnings going forward.
And taking a slightly wider view when, again, using the dollar as a touch point there, we've had Xi Jinping being announced as for an unprecedented third term. Generally speaking, weaker dollar tends to be good for Asian markets. Is this new term good news for markets?
I think overall it is. I mean, he's really tightened his grip on the Politburo over there. He's got rid of some long-standing colleagues, and he's brought in more people that are more aligned to his way of thinking and where he wants to take the Chinese economy. But one of the big factors for markets during the course of 2021 and 2022 was this zero COVID policy that the Chinese had implemented. We came through the supply chain disruptions of COVID, and we thought that was going to be the end of it, but the zero COVID policy being implemented by China has meant further restrictions on production and exports and supply chain difficulties. But the fact that they're starting to ease restrictions, not remove them, certainly is beneficial. He has also looked to try and address the ongoing issue of the indebted Chinese property sector. They've introduced some new tools to try and assist on distressed property developers. So net, it's generally a positive thing for markets. The markets have reacted well to the policies that they've introduced, and the policies are needed because we saw overnight industrial production in China came in a bit weaker than expected. Retail sales fell unexpectedly. So, the second largest economy in the world is struggling with the impacts of the zero COVID. And, when you have the second largest economy in the world struggling for growth, it does have a knock-on effect. So, to go back to your point, the weaker dollar certainly would be beneficial for emerging markets overall. Emerging markets generally would have a high level of dollar-denominated debt. So the fact that interest rates maybe start to come down late 2023, the dollar weakens, that is more supportive for emerging markets.
Okay, good to hear that. And One of the things I noticed as I was walking in this morning, it's getting a lot chillier. So of course, and the heating is beginning to come on. That brings me to Ukraine, the ongoing conflict there. What does this mean for energy prices? You know, what would your views be?
Well, energy prices in Europe have obviously been in the spotlight. We've seen it all with the significant increases in gas and electricity bills, notwithstanding the supplements that the government are giving households. That's only on the electricity side. But European gas prices have come down quite significantly over the course of the last number of months. Just to touch on the war in Ukraine, and it's still an ongoing horror story, but you know, Ukraine made a significant move last week by regaining some of their territory. And that's the first kind of positive development we've seen in relation to the conflict, if you can call it a positive development. But that's been reflected in European gas prices. European gas prices traded up as high as €320 per unit immediately after the invasion back in February. Prior to that, they had been trading at about €70 per unit. We're about €125 now today, still elevated, but significantly lower from where we were. And the other thing that's helped reduce energy costs in Europe, which is positive from an inflationary outlook for the ECB, is that the coordinated moves by the European Commission and all the EU member states to gain sufficient reserves to get them through the winter means that we're probably unlikely to see blackouts and fuel rationing and gas rationing. And that's important from a European growth perspective as much as anything else.
Yeah, and I think the strength of the midterms for Biden has also slightly strengthened Ukraine's position in terms of negotiations.
Yes, it has. I mean, the Democrats, having looked as if they may lose both the upper house and the lower house, have actually held on to the upper house. They may actually get one more seat, which would mean they don't have to rely on Kamala Harris as the vice president for the casting vote. The House is still up for grabs, but it looks as if the Republicans are probably going to get that. But you know, generally speaking, a divided Congress in the US has typically been positive for markets. It means that a lot of legislation that may not be market friendly can't work its way through Congress. So you know, it's not a precedent that is guaranteed to happen, but certainly the market reaction since the midterm elections last week has been relatively positive.
That is good news. And finally, I know it's not something that we cover particularly here at Cantor, but it is very much in the news at the moment. Crypto and the headlines that we're hearing about at the moment, a bit of a meltdown there. Yeah,
I mean, the crypto, it's not a topic that I generally discuss. It's not an asset class that we at Cantor promote, but certainly it caught the headlines last week because of the implosion of one of the smaller FTX, one of the smaller crypto exchanges. Primarily due to mismanagement of client funds within that company. But what it did do is cast the light over how safe and secure investments in crypto, these type of crypto companies are. You know, if you look at Bitcoin as kind of, I suppose, the flagship Bitcoin instrument, it's down 60% in the last year. You know, for the promoters of Bitcoin who were saying that, you know, it's a store of value, it would perform better than most other asset classes in volatile markets, that certainly hasn't been the case. And I think the issue for the crypto market now is there's been a lot of loss of confidence in it post what happened last week. And it also brings it right into the spotlight for further regulation, particularly in the US, where the legislators are really looking at how they should be regulating the whole sector. So what was encouraging last week, that despite the turmoil in the crypto market, broader asset markets, equities and bonds, both performed very, very well. And we would expect that, you know, for the reasons that kind of I've outlined in relation to expectations of interest rate policy in the US, the weaker dollar, incremental positives in China and in Ukraine, that we remain confident on risk assets going into the end of the year and into 2023. I would caution, however, that we've had a 20% bounce in European markets since their lows in September. So there's a lot of good news priced in at the moment. So I wouldn't be surprised over the next week or two to see maybe a little bit of consolidation or a little bit of give up in markets. But we would be looking to use any short-term weakness to add to exposure to risk assets.
Fantastic. David, as usual, thank you so much. Very much appreciated. I would say to any viewers out there, if you have any questions, please do get in touch with your Cantor Fitzgerald broker. Thank you.